Alright, as for hedging, we will be talking about the covered call first. Alright, for a covered call, you need two things. First, you need stock. Let's say you're invested in Delta Airlines, Dow, for example. Alright, first you need stock, then you need to sell call options on that stock. Here's how it works. Let's say you have 100 shares of Delta Airlines. You generally want to come out with 100 of whatever. So if you don't have 100 shares of Delta Airlines, it's a little different, but generally the same idea applies, all right? You might have 90 shares. It's more or less the same thing, but you generally want to have 100 shares for one call contract, okay? So this is the idea. Let's talk about Delta Airlines. Here's the stock. Let's say it's been going upward for quite a while, and right now it's at 50 bucks. I don't trade Delta, so I don't know what the real price is, but let's assume it's at 50 bucks. Now, you're a bit apprehensive about the price of Delta Airlines, but you think it's a good company. You want to stay invested, but you think maybe the stock market's going to fall, or probably trend flat, or it might not go, Delta Airlines might not go up to the extent that you want it to go up, okay? In this case, the covered call is going to be probably your best option, choice for hedging. Now here's how you do it. Let's say your price target for Delta Airlines is right here. Your price target is 60 bucks. If your price target for 60 bucks, by the way, if you have a price target, you should also have a date, okay? So let's say your price target is after 1 month. 1 month. You believe that Delta will trend up to $60. But you're not sure. It might not go up so high, you might start to trend sideways, and you don't want to expose yourself to the risk of holding on to a stock that's going to trend sideways or even downwards. Now you can alleviate the money you lose if Delta goes downward through covered calls, and you can also make money as Delta's going up as long as it doesn't go up past 60 through covered calls. So if it stays between 50 and 60, you've made money by the covered calls, and you've probably also made money through Delta if it's trending upward. Okay, so here's what you do. Here's the exact strategy. You have 100 shares of Delta. All right? You buy 100 shares of Delta, and you also sell one call option at this price, okay? If you don't know what a call option is, when you buy a call option, you need to put in two things. First, you need to put in the price, the strike price. You're going to put it at your price target. Then you need to put in the expiration date. The expiration date should be as close to your time for that price target as possible. So let's say it's June now, and you think Delta's going to hit 60 in July. Then what you're going to do is you're going to sell one call option with a strike price of $60 at the expiration date of July. When you sell that call option, you immediately get money into your brokerage account. And one call option can be worth a decent amount of money. It depends on the strike price and the month. But you're immediately going to get money. And if by July Delta did not hit $60, you're going to keep that money. If it goes over $60, you need to buy the call option back, but it's okay, you didn't lose any money because the stock of Delta, which you're holding on to 100 shares of, went up. So in either case, things are good. Now the disadvantage of this is that if Delta drops too far, the money that you got from selling the call option might not be more than the money you lost when delta drops. So it doesn't really give you downside protection, but it does give you protection against a sideways trending stock. So this is one of the best ways of hedging on a stock that you're not sure of the future prospects of. You might think it's a stable company, but it's been trending sideways. You want to hold on to the stock, but your friends are telling you, don't hold on to that, it's not going anywhere. Well, you've got a solution that allows you to hold on to the stock and make money at the same time. It's selling call options for the same stock with your price target and with the date. So what that's going to do is it's going to give you immediate income that you will keep as long as it doesn't hit your price target at that time. If it does hit your price target at that time, well, it's okay because the stock price has gone up. So you've got these. It's kind of like you've got two. What's a good analogy? I can't think of a good analogy. But you got two ways to win. All right. You got two ways to win and only one way to lose. So instead of just having stock where you only have one way to win, which is the stock goes up, now you have two ways to win. The stock goes up or the stock trends sideways. And you still just have one way to lose, which is the stock goes down, but you lose less because you've made money from selling the call option. So in either case, in all of those cases, the covered call is a better strategy than just holding on to the stock. And that's when I talk about, that's why I'm saying everybody should be hedging, even people who are long and think that maybe there is a bull market. You're always going to have a price target that you think is a little bit unreasonable, right? Let's say I really do think that delta is going to hit $60. Okay, fine. Why don't we sell the call option at the strike price of $70? Well, you're still going to make money off that call option. So even if we're in a bull market, you can still do covered calls and you can still make money. The only real disadvantage of the stock going up and you having a covered call option sold is if the stock flies the moon. If it jumps from $50 to $100, well, you've limited your upside there because this call option you have to buy back at a pretty high price. But you've limited your profit. It's not like you lost money. You didn't lose any money. You just limited your profit. But in general, over a long period of time, you're going to be making money because those events where a stock jumps from 50 to 100 are quite rare. So if you are in any stock that you're not sure it's going to skyrocket soon, do some covered calls. Sell some covered calls and make some extra money. There's no reason not to.